So in our last video, we've been analyzing the balance sheet, so wanted to continue further with a couple of ratios that are extremely helpful to me when I look at smaller companies and seeing if they have good liquidity, if they have a strong balance sheet, and making sure that the company is going to be able to survive any tough times. So this is Home Depot's balance sheet. Taken off the SEC Edgar website. It's a public site, so you're able to see that on the SEC website. So here we have the February 2nd, 2025 balance sheet, and then January 28th, 2024 balance sheet. So when looking at this balance sheet compared year to year, because it's a snapshot in time, you have your total current assets, $31,680,000,000, and then your total current liabilities of $28,661,000,000. So in order to understand the strength of the balance sheet a little bit further than just by looking at that, you can basically put it into a ratio. So with the current ratio describes how many times your current assets can pay off your current liabilities. Here we only have really if the current assets section of the balance sheet was liquidated, it would be able to pay off all the current liabilities one time and then have 0.1 left over, if you will. So you would have a strength of 1.1 times as of February 2nd, 2025. Now, when you look at the previous year, you could tell that the balance sheet was just a little bit stronger than it is as of February 2nd. And that's because your total current assets, even though the number increased from 29 billion to 31 billion, the current ratio actually was better because you had lower current liabilities. And this is something that a lot of people may overlook when you're comparing ratios, is you could take the 29,770,000,000 divided by the total current liabilities, 22,015,000,000, and you get 1.35. So basically, if all the current assets were liquidated, there'd be 0.35 times left of assets, if you will. So that's the current ratio. Now, the working capital ratio you can also include in there, and that's basically taking the total current assets less the total current liabilities. So you can also say that the working capital is $3,022,000,000 in 2025, February 5th, 2025, and then in January, the working capital was excess of that, so 7 billion. So in looking at this company, if say that this was a different company as of February 2nd, 2025, I would actually look at this company as having a lot stronger of a balance sheet than this company. So it's pretty easy to look at these ratios and be able to analyze the strength of this balance sheet. Now, these are more so current ratios. So I'm not looking at the total assets. I'm not looking at the long-term assets. I'm not looking at the long-term liabilities and long-term debt. So not looking at that just yet. But the quick ratio is another ratio just like the current ratio. So companies with inventory, I would rather use the quick ratio to analyze the strength of the balance sheet. And that's because a quick ratio takes out inventory and prepaid expenses. So if you take out inventory and prepaid expenses, well, sometimes at a retailer, inventory gets marked down. So if inventory gets marked down, you have to understand that it may not be as strong as you would think based on what you're looking for with the current ratio. So the quick ratio as of February 2nd, 2025, was 0.23, and then what was it here? Quick ratio was 0.32. So as you can see, 2024 was a lot stronger balance. Well, as of January 28, 2024, the balance sheet was a lot stronger for Home Depot.